Are you thinking about buying a house, but you aren't sure when because you're worried about a housing crash? Today I'm going to share with you 15 housing market indicators to watch to help you time the real estate market. 2 days ago, I did a video on this very topic. The problem is, I took too long to get to the point, so most people never saw the actual content. So if you sat through that whole video, you might want to skip this one, but if you didn't, these 15 indicators are pure gold for predicting the direction of your real estate market. Let's dive in. Let's start with traditional indicators. These are the ones that people typically look at for clues to where the real estate market is going. Now, as we go through these, I'm going to explain what they are, and then I'm going to use Reno, Nevada as an example because that's a market that I have data for. Number one, existing home sales. Current home sale activity is one of the best leading indicators because buyers and sellers are setting prices in real time. When you have a lot of buyers and not many sellers, prices go up, which is a trend we've been seeing for the last few years. Conversely, when you have a lot of sellers and not many buyers, prices go down, which is what we saw from 2007 to 2012. You can look at sales 1 month compared to the next to see short-term trends, or you can look at them year over year to see if the trend is going up or down over a longer period of time. In Reno, home sales were running above what they were in 2019 until about the third week of March this year, when the effects of the pandemic began to take their toll. And by April 25th, closings were down 44% compared to the same time period last year. Let's look at the pendings pipeline to see what's coming next. Pending home sales. For those who don't know, pending home sales are when a seller and a buyer have entered a contract, but the house has not yet closed. Pending home sales are an excellent indicator of current purchasing interest because most of them will go on to close. Roughly about 15% will fall out of escrow. Although the final prices are not yet known, the asking prices in the MLS indicate that they were reasonable enough for a buyer to actually go through all the trouble of writing an offer, negotiating with the seller, and getting into contract. In Reno, after peaking in mid-February, pendings went down every week through the end of March. Then in April, they started trending back up. So most of these pendings should show up as closed sales in 30 to 60 days, a very good leading indicator of buyer demand. 3, month supply of inventory. Now this is one you hear realtors talk about a lot, but it's a really good indicator of how competitive a market is for buyers versus sellers. It basically measures how long it would take to completely sell everything at the current rate of demand if no new properties came on the market. Below 6 months is considered a seller's market, 6 to 7 months is a balanced market, and above 7 months is a buyer's market. In Reno, because the number of new listings dropped all through March, but buyer interest remained steady, as of late April, we still only have 1.5 months of inventory despite the pandemic. An important thing to note, however, is that month supply of inventory often varies by price range. Typically, month supply is much tighter in the low end of the spectrum. So for example, it can be a seller's market in the low end where you've got lots of buyers all competing for a very limited number of properties. And in the same city, it can be a buyer's market for the more expensive properties that have been sitting around for months with hardly any showings. Number 4, new home building permits. Home building is a tough business and you need to be a real optimist to get to the point of actually pulling a building permit. Home builders are keenly aware of buyer demand. Historically, building permits tend to decrease ahead of recession and they tend to increase before coming out of recession. So in Reno, as this graph shows, we've been on a slow, steady uptrend for years, and we're nowhere near the levels we had prior to 2008. We'll see what happens post-COVID, but I don't expect any major changes because we have a lot of buyer demand in Reno and not a lot of land that's easily developed. According to the Nevada Builders Association, less than half of what's really needed is being built. Number 5, mortgage defaults. Coming into 2020, mortgage delinquencies on loans of all types had fallen to their lowest in 40 years. Mortgage delinquencies are closely tied to unemployment. So if we can't get people back to work soon, these will rise. In Reno, like most places in the country, we've had a recent noticeable spike in unemployment. In March, it jumped from 3.2% to 5%. So this is one to watch in the coming months. Currently, 7.3% of U.S. mortgages have entered forbearance. Once that forbearance period ends, and if they still can't pay, they will be motivated to sell, which may mean lower prices if buyer interest wanes. Or in the case of Reno, it may mean moving from an extreme seller's market into a more balanced market. Number 6, foreclosure sales. When foreclosures are rising, the demand for real estate is falling, and they tend to be a lagging indicator for market peaks. Pre-COVID, 1 in every 2,777 properties in the U.S. received a foreclosure filing in January 2020, according to Adam Data Solutions, and this number was trending down. In Reno, this graph illustrates how few we currently had coming into 2020 versus the Great Recession. However, post-COVID, this is one to watch in the next 8 to 18 months, and it will lag mortgage delinquencies. 7, interest rates. The higher interest rates climb, the more the downward pressure on home prices. Conversely, lower rates tend to push home prices higher as buyers can afford to pay more. Right now, we have the lowest rates in history, and I don't see any indication that they're going to rise in the coming months. Prior to the pandemic, these were the expert predictions for the year. They may go lower as the Fed tries to stimulate the economy. So in Reno, this means that qualified buyers will continue to be able to afford more. There are 2 caveats to that, however. 1, lending standards have risen since the outbreak, which means you typically need a 660 to 700 plus credit score and 20% down to qualify for lending. 2, the jumbo lending market, which is typically anything over $510,400, is kind of frozen at the moment. So more expensive homes may be more difficult to sell while the banks sort that out. Number 8, purchase mortgage applications. Another good indicator of buyer intent are applications for lending to purchase a home. Reported weekly by the Mortgage Bankers Association, since the onset of COVID-19, applications have taken a bit of a nosedive and are currently at 20% down year over year. This graph from Calculated Risk does an excellent job of showing historical context. Yes, that steep little drop at the end is one to watch, but we are nowhere near the nosebleed levels of 2007. Number 9, unemployment. Believe it or not, unemployment is not 100% correlated to real estate because you have retirees buying and selling who no longer work, and you have people with the means to pay cash. That said, 86% of all home buyers use some kind of financing to purchase their house according to NAR, so it is a big factor. With roughly 20% of Americans unemployed and potentially more, this is definitely a wild card to watch. But as I said in my post-COVID prediction video, there are many data points suggesting that the housing fallout won't be that bad, so watch that video to understand why. So those are some of the more traditional indicators that people look at. Now let's look at a couple of more unusual ones. Number 10, Google Trends. One unusual way to gauge sentiment on the housing market is to head on over to Google Trends and see what people are searching for related to real estate. Here you can see that I'm comparing terms for buying, selling, forbearance, and the housing crash. Buying always has more traffic as new buyers come into the market and Google for answers about the buying process. Sellers have already been through it at least once before. But I think it's interesting to see how the gap between buyers and sellers has just been getting larger and larger over the years. This suggests more buyer interest, probably from millennials, which we'll get to in a minute. Number 11, portal traffic. Since 93% of all home buyers use the internet to search for homes, another interesting indicator to look at is real estate portal traffic. You can do this by using a free tool such as SimilarWeb, which I use to create this graph to compare Zillow traffic to Realtor.com. As you can see on the graph, it's normally fairly steady with a little seasonal variation. But if traffic drops off for some reason, real estate may follow. Zillow recently reported that its search traffic dropped 19% from mid-March to mid-April, with some metros dropping more precipitously than others. But it's since come back even stronger than before compared to this time last year. Number 12, Demographics. This one is probably the most important indicator of what's to come in the housing market that we sometimes forget to think about. Real estate is driven by life events because shelter is a basic human need. For years, we've been hearing that millennials aren't buying because they have too much debt, or they don't have jobs, or they'd rather rent, and they prefer to travel the world. It's not their lifestyle. That's all changing. 72 million millennials, the largest generation ever, are getting older, they're getting married, they're having kids, and some are even moving to the suburbs. Millennials represent 38% of all home buyers. They have jobs, they have money, and the desire for a place of their own, especially now in the aftermath of COVID-19. And in fact, NAR estimates, given their numbers, that we are underbuilt by 4 million homes. ShowingTime. ShowingTime is a software package used by many brokerages and MLSs across the United States, and they collect data on showing activity, which is a fantastic indicator of buyer intent. People normally go out and look at houses before they buy, and even in the era of COVID-19, they've introduced a virtual showing feature, so they're still tracking virtual showings across the US. And so as you can see in this graph here, the showings took a major dip right after the lockdown, but then they started to bottom out, and now they've started to come back up in sort of a check mark pattern. Now I'm looking at California's pattern because the Nevada pattern, I have to say, is a little bit flatter. I live in northern Nevada, and when you look at the whole state, that's a Las Vegas market driving our state result. And so where I live in Reno, our pattern is a lot more close to the California, which is why I'm showing it. I'll put a link to this page below, but you can go to any state in the nation and you can click on it to see what your state looks like in terms of showing appointments. The other indicator I want to mention is the number of new listings coming on the market. So when you put a new listing on the market, that is a lot of intent on the seller's part, because they have gone out and found a real estate agent, they've signed a listing agreement, they've gone to all the trouble to get the house ready with pictures and cleaning up the yard and everything, and they put it on the MLS. That indicates a high degree of intent. And while buyers drive demand, sellers drive supply. And if you don't have supply, you're not going to have much of a market. So watching the number of listings coming on the market, especially post-COVID, is going to be really critical to see how this buyer and seller tug of war plays out. In Reno, new listings have taken kind of a nosedive, and we're still waiting for them to recover. So these are the indicators to watch when you want to buy a house and you're trying to time your real estate purchase. In Reno, these indicators are telling me that post-COVID, there's still a lot of qualified buyer demand and not that many homes to choose from in the affordable price ranges, so it's going to be a competitive market for the time being. If unemployment goes higher, or inventory goes higher, that may change. In the higher price ranges, I'd have to dig a little deeper to understand the buyer-seller dynamics, but I suspect it's a little easier for buyers, assuming they can get financing in the higher price ranges. To make this easier, I've created a housing market checklist to help you assess your local market and predict where it might be going. And I'll put a link to that in the description below. So did I forget anything? Put your thoughts in the comments below. I'm Diane, and I am a realtor with Chase International, an independent brokerage not affiliated with the bank. We are the leading brokerage in the Reno, Tahoe region, California, and Nevada, with nearly $1.5 billion in annual sales. If you need help finding a trustworthy professional to help you anywhere in the nation, please reach out. I have an excellent network. Don't forget to like and subscribe, and I'll see you next time.